All right, so this is what we're going to do. Let's go through it. Here's just a couple of things calculating implied volatility with the known option price. Here's things that goes into your options pricing model. Just for you guys to have a little bit better understanding so you understand all these things. You have the stock price, you have the strike price of the contract, you have the time to expiration, you have volatility, right? IV. Is it low? Is it high? Is it average? For life members, you get something around noontime every day from me. I send you guys out the increasing and decreasing volatility on all the stock names. So you get that from me every day. Interest rates and dividends as well. They all have everything to go into what makes up your options price, okay? Just a little knowledge for you guys, okay? So is there a difference in terms of how you trade a smaller account versus a larger account? The short answer is absolutely, you do. You have to. People will have different opinions. Okay, they'll have different opinions on should you be riskier with a smaller account, because if you're riskier, you can potentially, if you shoot for the moon and you hit it on your trade, you just doubled, tripled, quadrupled your account. Let's all remember what Trey did with his $550 Tesla call, and he turned it into $12,500. Okay, I mean, that's what he did. He had a small account. He went risky, and it paid off. There's times it's not going to pay off. You don't want to be that guy. I would suggest you don't go crazy with it in terms of risk. You have to think it through. And if you have a really small account, you don't want to do a lot of unusual options activities. You just don't want to. You want to do trade of the week, okay? You want to do trade of the week, and you want to do general sharp callouts. Those are the trades you want to do first when you have a small account. Because first of all, a lot of you guys don't have the patience to wait on the unusual option activity plays to play out, okay? And you don't have the experience to do that when you see something down 50, 60%, which happens with those. And then they go shooting through the moon, 100, 200, 500, 1,000%. That's what they do. Guys have been here long enough, they know that that's what happens. You also have to go smaller with unusuals, all right, than you normally would on trade of the week and things like that. The largest trades I'll do is trade of the week. That's what I do. That's where the majority of when I am putting percentages and dollar amounts into trades, trade of the week gets the most. The reason being, it is a very detailed technical trade. So in terms of risk, I would say if you have a small account, it's trade of the week. Okay, that's what you do. Do trade of the week. Do trade of the week 4 times. You're probably going to win at least 3 times, if not 4 times. And if you do it for 2 months straight, you'll probably win 7 out of 8 times. Okay. And your wins will be anywhere from 30% to over 100%. If you can do that, you do 8 trades in 2 months and you double or triple your account, I think you'll be pretty happy with that. All right. This is not meant to get rich quick. And I say that it's in my channel where I have put out for you guys, my thoughts about what we're here to do. Okay, that's not what we're here to do. All right, it's not what we're here to do. All right, and also, I don't want you guys over trading. I'd rather do like 2 trades a week, and they win, or do like 5 trades a week and 4 out of 5 of them win, than having you guys do 15 or 20 trades a week. That's insanity. Other guys do that. I don't feel that that's appropriate. For those of you that don't use Robinhood, you're paying commissions on all those trades. Is that really what you want to do? I don't think so. I don't think you want to pay commissions on all those trades, especially, you know, if 20% of them are losers, you paid commissions and you've lost. All right, so here's the risk. Options trades that use low price stocks and ETFs can be sized so that dollars risk per trade will be relatively small. Okay. Obviously, if the account is smaller, the percentage of your risk is higher. That's just the way it is. And it's laid out there for you. A $5,000 account versus a $1,000 account. Okay. So $100 and a $5,000 account is 2% versus a $1,000 account, it's 10%. Okay. So that's just a starting point for you to start understanding how to manage your risk in a smaller account. Okay. That's why I always say, if you have a smaller account, you shouldn't be betting the farm on one trade. All right. So like if you get into trade of the week contracts are going to be anywhere from usually $1.25 to like $2.50 by the time we get in. I'm okay with you doing a trade of the week account on a $1,000 account with $250. And the reason I'm okay with that trade is because it is a complete technical trade. Okay. The way you lose in that trade is if the technicals break down and go against us. All right. And if that happens, close the trade out and we usually flip to the other side. All right. So if we're in calls and it breaks down, then we flip to puts. And I've seen plenty of times where guys have made money on the call side, then the trade breaks down, and then they turn it around, they make money on the put side. Okay. So it's possible. And like I said, if you take that trade once a week and you win 7 out of 8 times over 2 months, you're going to double your account. It's going to happen. Okay. Just don't overtrade. Another thing is to know your max loss. Okay. See, options are easy to understand because if you're going long a call or long a put, it's like I write in Trade of the Week. The most you can lose is what you've put into the trade. So if the contract's $2.50, the most you can lose is $250. That's it. You know that that's it. That's all you can lose. All right. Most traders do not trade in a way that allows you to reach your maximum loss because you'll have a stop. All right. Most will. And like I said, we're not talking about unusuals here. We're talking about technical trades and general shark callouts. All right. You want to manage your position with basically with your trading plan. Everyone's got to have a trading plan. You guys should have a trading book. You should write stuff down. If a trade went in your favor, you had written it down. If a trade went against you, you want to know why did it go against you? Is it because of earnings? Is it because the market turned around? Did Trump tweet something? Did the Fed chairman come out and say something? What happened? And why did your trade lose? Okay? Because then you can start to figure out your pattern and say, okay, maybe I really shouldn't trade earnings because I really suck at it. I don't trade a lot of earnings just because it's not worth it to me. If I do trade earnings, I do a spread trade of some sort unless somebody talks me out of it, and you know who you are. Derek. Because I remember that trade. That's all right. So, you know, but I'm going to get into that. Yeah. You didn't know anyone like that. Nobody talked me out of a trade that would have made a killing. But that's okay. Now, here's the thing, and I always say this because everybody is different. Guys ask it to me in DMs. You guys ask it to other guys in the chat itself. You know, like, what should I set my loss at? Well, everybody's different. Okay? Everybody's different in terms of a small account. You know, I would say the most you ever want to really go on a small account is 35% on your losses. But see, then on the flip side, you have to be willing to let that winner run. All right? Because if you cut your losses at 30, but you take your profits at 20, you're still losing 10. You guys follow me with that? So you want to let your winners run a little bit if you're going to allow your losers to go to 30, 40, even 50%, which is fine. It's whatever works for you. But you have to do it consistently, and you should have it all written down in your book, which is what I keep telling you guys. All right? So if you set up a dollar-based maximum loss for your options contract position, so you buy a contract, you have to know what that means as a percentage of the account equity. All right. So if you've got $1,000 account, okay, and you take a contract for $250, right? Because that's 25% of your thing. So then if you have lost, let's say 50% and it goes down $125, you have to know what that means in terms of how much of my account just went down. And like most of the things will tell you, most of the platforms tell you the percentage gain loss on each position as well as your account in any trading day. So usually it's already marked out for you. So you just want to have that in the back of your mind. So you say, all right, what's my max loss that I'm willing to take when I get into a trade? I saw somebody say something the other day, and he said, well, when should I get out of a trade? Very open-ended question, because everybody's going to give you a different answer. Now, I did see some of the life guys chirp a little bit and say, you should know that when you get into the trade. That is exactly the answer I would give. You have to know where your max loss is, and also when you're going to start taking off as you're gaining. Like, for example, on Trade of the Week, I started trimming it as I was at, I want to say 50 to 60%. I started trimming it. I didn't take half off. I just took a couple of contracts off because I wanted to take some profit. And there's nothing wrong with that. But if you have a small account and you only have one contract, okay, you want to make sure that if you're getting a winner, you want to let it run, but you do not want to give away profits, okay? My rule of thumb is in a small account, when you're talking about profit, all right, because we're talking about loss here, you have it on the screen so you can see it. When we're talking about profit, all right, so let's say you get something and it's up 60%, all right? Unless it's a purely technical trade that's laid out like a trade of the week, all right? Let's just say it's your own trade. You're up 60% on a contract. You should not walk away with anything less than a 30% profit. Never, ever give away more than half of your profit. That's my advice to all of you, especially if you have a small account, okay? Never give up unless it's a contract that is, 3, 4, 5, 6 months out and you plan on holding it for months and months and months. Okay, then you know that it's going to go up and down. All right? That's the only way you do it. But if you have short-term expiring within the month and you're not playing earnings and you're not playing an event of any sort, then once you get down to half of whatever your gain was, it's time to sell. Take the profit and move on. Okay? You guys all understand that? Does that make sense to everybody? I know the guys that have been with me a while, you've heard me say that. I just want to make sure you guys all understand that and that it makes sense. And if you have a question, I want you to ask it. All right? If you have a question as we're going through here, just that pertains to this subject, just fire it in the chat, all right? Because I don't want you guys just to sit there and be like zombies, all right? So here you go, okay? Here are 2 strategies that you can use in a smaller account because it's great risk reward, all right? The butterfly and an iron condor. You can do iron butterfly, you can do butterfly, you can do condor, iron condor. Personally, we like iron condors and iron butterflies, all right? So these are how you may set them up, all right? The goal of the strategy on the butterfly is to keep the market trapped under the break-even lines without taking too large of a loss. Okay, the benefit of trading this strategy is the position will generally make money on the downside. All right. One of the good things about trading a butterfly is that the risk-reward ratio is relatively favorable, like I said, which makes the strategy more forgiving. Can't tell you how many times we've made plenty of money with iron butterflies and iron condors. Okay. Iron butterflies just mean it's the same strike. Iron condor means it's not the same strike in terms of the middles. Okay. Usually the middles are the ones we're selling. That's what makes them iron. Don't ask me why they got that name. That's just the way it is. All right. So there you have iron condors and butterflies. And I think on the next page, I did. So there you go. See, Demon, you're going to get a shout out tonight. Demon, do you want to talk about these two trades that you set up this week? I know I'm sort of putting you on the spot. I don't know if the Rugrats are in the background. I don't know if the Rugrats are in the background making noise. Do you want to break these trades down, being as they're yours? I can unmute you and you can talk. But you have to tell me in the chat if you want to do that or not. I know we're sort of going on the fly here. I didn't tell you about that beforehand. See, I'm just full of surprises here. He's probably not even on. He's having a cigarette. He went to get smokes. All right. So I'll start breaking down the first trade, which was the JP Morgan Iron Condor that expires this coming week. Okay. So the inside is going to be sell to open the 95 put and sell to open the 100 call. The outer, meaning the wings, is going to be buy to open the 93 put, buy to open the 102 call. Okay. So your inside spread is $5, 95 to 100, right? And then your wings are $2 to each side. Okay. You're getting a credit of 77. Your marginal impact is $123. All right. And it is like what he wrote there, because that's what we do. When we do a trade like this, we're going to tell you about it. And that's what he did for you. It's a tight iron condor looking for continued sideways movement for financials in a very short-term iron condor. If that trade closes between 95.01 and 99.99 on Friday, you get to keep the entire 77 cents per condor that you did. Okay? You get to keep the whole thing and you make all the money. Okay? Now, if it goes to 94.50, you're still going to be profitable. Okay? So how you would figure it out, I'm just going to do it basic. I'm not going to chart it. I'm not going to do it on a whiteboard. I'm just going to tell you guys how to do it. So to the downside, what you would do is you have a $2 spread to the downside, right? 95 put, 93 put. You're selling a vertical put spread. All right? Take $95 minus 77 cents, and that gives you 94.23 is your break even to the downside. Now on the flip side, to the upside, you have the $100 call and the 102 call. Your break even to the upside is $100.77. Okay, so 177 cents and 94.23. As long as you're in between there, you'll make money because it's a credit spread. Okay, so you got paid to take this trade. Net credit 77 per. Do you guys all understand that? Does anyone not understand that? Great trade. The only way you're going to lose money is if it breaks out or it breaks down. And that is a great trade for a small account. And that's why he has the spreads channel here at FTP. Okay? That is a great trade because that's what he's looking for when he's doing these trades. Okay? He's looking for trades to put in the spreads channel for you guys so that even you guys with smaller accounts can take this trade on. Okay? All you need in your account is $200 to do this trade. They'll let you do it. They should let you do it. Unless they give you crap about margin and whatever, even though it's stupid that you would need margin. And Derek and I both agree on that some of the rules that they have here are really stupid for traders. All right? So that's the Iron Condor trade. Now we're going to move over to the Iron Butterfly. Okay? It was Nikola, September 4th. So it's not this Friday. It's next Friday expiration. Okay? So your inside strike is 41. So you're going to sell to open the 41 put. You're going to sell to open the 41 call. Do you want to break this trade down audio or you can't do it? Derek, do you want to talk about this Nikola trade? Or you don't want to talk? Or you don't want to chat? Anyway, just let me know in the chat. I guess there's a delay from the time you guys hear me until you're in the car driving back. All right, that's fine. So I'll do it. Just let me know if I do a good job breaking your trade down. So here we have Nikola, September 4th, Iron Butterfly. Okay. So Butterfly is the same strike price for your insides. All right. So you got the 41 call and put. Sell to open, both. Buy to open the 36 put. So you got a $5 vertical put spread to the downside. Buy to open the 46 call. Now you have a $5 vertical call spread that you sold to the upside. Net credit is 364. Why the hell didn't I get into this trade? That's the question I got to ask myself. I didn't see this trade. I know why, because the volatility is high on this name. That I know for sure. And I think they had earnings in the last week or so. But this is a very volatile name. Nikola is a very volatile name. As you guys know, it was well over $60 maybe a month or so ago. So net credit is 364 for a $5 spread. So that means your maximum risk is only 136. Okay? So here's how you're going to figure out your break evens on this trade. You will have to trade out of this trade one way or the other before expiration. Like the other one, you could have held it all the way into expiration because you had a $5 spread between the put and the call that you sold. Okay, so you had a little grace area there where if it closed between there, you get max. You're not getting max on this one. It's just not going to happen. Okay, not going to happen. So for the upside, you're going to have sell to open the 41 call. You're going to add 364 to it, which is your credit. Okay, so it's going to be 44.64 is your upside break even on the calls. Okay, so if it's below 44.64 on your calls, then you should be making money on the call side. Now, if you flip it over and you go to the downside, your break evens on the downside is $41 minus 364. So that is 37.36. Do I have that right? 37.36. Yep. 37.36 is your downside. That's pretty good with no calculator. So between 37.36 and 44.64, you are profitable. okay? The closer to 41 that you can stay on this trade, the better. And you can see his note there, only 56 deltas here on a very volatile ticker, so he's keeping it very small, okay? Meaning he didn't do a lot of them, okay? He didn't do a lot of them. So I'm just going to look up real quick. Give me 1 second. Let's take a look at Nikola and see, because I don't have any idea where it is. It's at 39.37. So as of right now, this is a profitable trade. Okay? This is a profitable trade because the call side, as of this moment, would expire worthless. And the put side is at 39.37, which is $1.63. So you're almost $2 in the money on this trade to the downside, plus the okay, and that's just to the downside. All right. All right. Any questions on the iron butterfly? Anybody have questions on that? Again, these are two great strategies for you to utilize with smaller accounts. Okay, versus doing straight calls and straight puts. All right. These are really two great strategies to utilize. All right. Nobody's got any questions? All right. Well, check out Derek's spreads. You can find these in the spreads channel inside of the trading room. All right. So what I have here that I put up was just some winners from the week that guys had. All right. So here's some winners from the week that you guys had. So I just wanted to put them out there. All right, for everybody to see. Now, do you guys have any questions on trading the smaller accounts before we move on to your stocks? Do you guys have any questions? Now is the time to ask them. And no question is a dumb question, because if you're asking it, that means you don't know the answer. And our job here is to try and help you learn so you don't make the same mistake twice. Okay? Anybody have any questions on trading small accounts? No?